If you've got £100,000 saved and you're wanting to put this into property, you'll have multiple decisions to think about, like the type of property you want to buy and where. I'm Judy Haliwell, UK Sales Director at Select Property. We've handled over £3 billion in property sales since 2004, and in my 20 years in property, I've guided hundreds of investors, many starting out with similar capital. I've assisted these investors with the types of properties to invest in and helped them to identify where in the UK their money will work best for them. In this video, I'll show you where £100,000 works best in the UK right now, the types of properties to consider, and how best to use your £100,000 as a deposit. Now, the first step is your investment strategy. Before we get into where you should invest your £100,000, there's a key consideration for investors, and that is your strategy. If you're looking for a quick turnaround, such as buying and flipping property, then you may be missing out on long-term wealth and risking high costs of renovation into profits. And it's not only renovation costs to consider, but also stamp duty. This buy and flip method often isn't the most profitable anymore, so choosing your route to investment is even more important to get right. For investors seeking long-term wealth, a higher value property may be more suitable, as not only can it generate passive income for you through rental returns, but usually it allows you to buy prime investment locations, which will always be sought after. Then, when the time is right for you, you could even sell the property for capital growth advantages. In my latest video about property portfolios, I've run through the different types of strategies in more detail, so take a look at this if you're not sure what's best for you. So, now we've considered your strategy, let's think about your capital. Say you've got £100,000. In some areas, this could buy you a property outright, but it likely won't be a property that is in very good condition, and usually, whilst they could have apparently high yields, the capital growth side sometimes can be far more limited, and exit sometimes tricky. Instead of using all of your capital into buying a property outright, consider using it as a deposit. You can secure a buy-to-let property with a deposit of usually around 20 or 25%. A substantial deposit like £100,000 can then benefit your financing options as it can open up more mortgage products. And when I talk about a mortgage, I mean a long-term loan most people in the UK use to purchase property. Mortgages are repaid monthly, and there is an interest rate added on top of the amount you need to borrow, often in line with the UK interest base rate. You can find out more about mortgages in my full UK mortgage guide video linked below. But let's get back to your £100,000. By having a higher deposit, such as a 20 or even 30%, your LTV, which is your loan to value ratio, is reduced. And this can sometimes mean you can get a lower mortgage deal with a lower rate. Let's say you found a £350,000 investment property. If you put down your full £100,000 as a deposit, that's roughly 28.5% of the purchase price. With this bigger deposit, at the moment, on a 5-year fixed interest rate, for example, you might secure a rate of, say, 4% instead of 4.7%. On a 25-year mortgage, this could save you over £40,000 in interest payments. That's an extra £1,800 per year directly into your bank, whilst your property potentially appreciates in value at the same time. Next up, the type of investment property you want. You could buy a property such as a house in a local town, maybe buy student accommodation that already has a license, or buy a premium apartment in a popular location. In my experience, apartments, particularly high quality apartments, offer a good option for investors with both a long-term mindset and those who want a hands-off investment. If you buy a house, for example, you'll be subject to any major repairs yourself. Say the roof maybe needs replacing. The entire cost will fall on you alone. Plus, there's the added time spent organising renovations. With a property such as an apartment, however, you'll pay an annual service charge. This is a collective payment all apartment owners in your development pay, and it contributes to the ongoing running costs, major repairs, whilst also keeping the residents to a high standard, allowing investors to both push rental rates and achieve high occupancy. This keeps your outgoings predictable and more stable. Next, let's think about what you want to do with the property. You need to have a think about who will be living there. Houses are typically more suited to families and couples, as they provide facilities families usually prefer, such as a garden and parking. Apartments, however, particularly those in city centres, are suited to a wider demographic, like couples, friend sharing, students and individuals. By owning a property in a high population area and a broad spectrum of tenants, you'll likely find it easier to let the property, meaning your void periods are less and your income is more consistent. It's also important to consider the type of tenants you want to attract. For example, an apartment in a high-end development with a range of amenities such as co-working lounges, gyms, they'll likely attract young professionals who will be willing to pay a premium for these included within their rent. Now finally, where should you buy? We've all heard the old phrase, location, 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 with many people saying it is the most vital consideration when purchasing a property. And in my experience, that is absolutely true. Location is crucial because it is the one element of property that cannot be changed, and it can significantly impact lifestyle and property value. After all, for prime land, there is only a finite amount, and this helps to drive growth longer term as populations are forced to spread. You can change a property's kitchen, furniture, but you can't move where it is. So when you invest in property, you're really investing in the town or city's local economy, infrastructure, and demand. And this is absolutely key. A great location does two things. First, it protects your income by ensuring high tenant demand and less void periods. And secondly, it drives the property value up through capital appreciation. The best properties don't just grow in line with the market, they outpace it because of where they sit on a map. So, where are the best locations for property investment in the UK? Previously, it may have been London, but if you look at this chart showing recent London property values, the market hasn't just gone stagnant, it's actually declining in some areas. Meanwhile, if we look at the largest cities outside of London, you can see the other parts of the UK are experiencing major growth. Let's look at this forecast chart by industry researchers JLL. Birmingham is leading the sales value forecast, with property prices to increase by a staggering 24% by 2029. Other cities, such as Manchester, Edinburgh and Leeds, are also set to see major growth, with Manchester and Birmingham predicted to see an 18% increase in rental growth by 2029 as well. My advice is to follow the data and the institutional investment. Do your research and buy where there's potential for significant growth, not stagnation. But why even these areas at all? Why a city? For property investment, cities tend to outperform more rural areas or towns or villages. Essentially, there's more people wanting to live there. Tenants have more career opportunities in major cities, and they're the base for global employers as well. In fact, 80% of the FTSE 100 companies hold an office in Manchester, which attracts people from all over the UK. Secondly, a lot of these cities, such as Leeds and Birmingham, are major educational powerhouses with top universities. Tens of thousands of students each year descend on these UK cities, and once they graduate, a lot of them choose to stay, known as graduate retention. For example, 50% of graduates remain in Birmingham after they finish studying. There is a consistent stream of tenants that way. Finally, cities offering unrivaled culture. In Edinburgh, for example, there's castles, unique streets, and localities you won't find anywhere else. Manchester boasts some of the most successful football teams across the globe, in addition to an incredible music scene, and Birmingham holds the most Michelin star restaurants outside of London. Generally, the people who are renting a property are younger, in their early 20s or 30s, and they want the buzz of city life. Therefore, cities that have a strong culture, student population, and career opportunities always have a high tenant demand, meaning your returns and your investment will be more successful. So let's summarise. If you've got £100,000 to invest in property, follow these key steps. 1. Identify your investment strategy. 2. Be smart with your capital. Leverage your LTV to try to get a lower rate. 3. Figure out what kind of property you want. And 4. Buy where there's demand and follow the data. Over the next few weeks, we'll be releasing more videos that break down the best locations, strategies, and opportunities in the UK property market. If you want to stay ahead of the curve and make smarter decisions with your money, make sure you subscribe. That way, you won't miss any of the insights that could shape your next investment.